Module Overview Business Budgeting is the foundation of a company's financial planning process. It enables businesses to allocate resources efficiently, track performance, and ensure financial stability. In this module, we will introduce the concept of business budgeting, its importance, the various types of budgets, and the key principles that underpin effective budgeting. By the end of this module, you will have a comprehensive understanding of what budgeting is, why it's essential, and how it serves as a strategic tool for business success. This module also covers the following key areas: the definition of business, budgeting, the importance of budgeting, types of business budgets, key budgeting principles, the budgeting process. 1. What is business budgeting? Business budgeting is the process of creating a plan that outlines an organization's financial and operational goals and how it intends to achieve them. A business budget serves as a financial roadmap, helping managers and executives plan for future expenses, predict income, and assess potential cash flow shortages or surpluses. Budgets are crucial for every type of business, from startups to large corporations. They not only help businesses manage resources but also act as benchmarks against which actual financial performance can be measured. A budget is essentially a projection of income and expenditure where resources are allocated based on strategic goals and priorities. 2. Importance of business budgeting. The process of creating a business budget offers several advantages for a company, including 2.1 Financial control. A well-constructed budget ensures that the company spends within its means and does not exceed its financial capacity. Budgeting helps track and control spending, preventing unnecessary costs and improving overall financial health. 2.2 Strategic planning. Budgeting allows a business to align its financial resources with its strategic goals. It helps prioritize spending on critical business activities such as marketing, research and development, expansion plans, and operational efficiency. 2.3 Performance measurement. A budget serves as a tool for measuring business performance. By comparing actual performance against budgeted expectations, businesses can identify variances and take corrective actions if needed. This helps in improving decision-making processes and refining business strategies. 2.4 Risk management. Effective budgeting helps businesses identify potential financial risks before they become problematic. Businesses can anticipate cash flow problems and manage their debt obligations better, reducing the chances of insolvency or bankruptcy. 2.5 Investor and stakeholder confidence. For publicly traded companies and those seeking external financing, a clear and well-organized budget can enhance confidence among investors and stakeholders. It shows that the business is being managed in a financially responsible way, helping attract potential investors and secure loans. 3 types of business budgets. There are several types of budgets that businesses use depending on their goals, operations, and size. Below are the most common types. 3.1 Operating budget. The operating budget is used to plan and track the day-to-day expenses of a business. It includes projections for revenues, expenses, and profit. Operating budgets are typically broken down into categories such as revenue projections, cost of goods sold, COGS, operating expenses, administrative, marketing, payroll, and more. 3.2 Cash flow budget. The cash flow budget is focused on ensuring that the business maintains sufficient liquidity to cover its immediate financial obligations. It tracks the timing of cash inflows and outflows to ensure the business can meet its short-term financial needs, such as paying suppliers, employees, and bills. 3.3 Capital budget. A capital budget focuses on large, long-term investments. This could include the purchase of equipment, facilities, or new technology. Capital budgeting helps businesses make informed decisions about how much to invest in their long-term growth and how to finance those investments. 3.4 Flexible budget. Flexible budgets are designed to adapt to changes in business activity levels. Unlike fixed budgets, flexible budgets can adjust based on fluctuations in sales volume, production levels, or other factors that impact financial performance. 3.5 Zero-based budgeting. Zero-based budgeting requires managers to start from a zero base and justify every expense for each period, rather than simply adjusting the previous period's budget. This approach ensures that every expenditure is aligned with the company's current goals and priorities. 4. Key budgeting principles. To create an effective business budget, there are several key principles that should be followed. 4.1 Accuracy and realism. Budgets must be grounded in accurate data and realistic assumptions. The projections should be based on historical financial data, market conditions, and reasonable expectations about business performance. Overly optimistic or conservative budgets can lead to poor financial management. 4.2 Consistency. Budgets should be consistent and aligned with the company's overall financial strategy. If a company's long-term goals shift, the budget should reflect these changes. However, changes should be done thoughtfully, with careful analysis of how they affect the business. 4.3 Flexibility. A good budget is flexible enough to adjust to changes in the business environment. Businesses must be able to modify their budgets as needed in response to new information, market changes, or unexpected financial circumstances. 4.4 Involvement of key stakeholders. Creating a budget should not be a solitary process. Key stakeholders from different departments should be involved to ensure that the budget accurately reflects the operational realities of each part of the business. Engaging stakeholders helps foster a sense of accountability and ownership across the organization. 4.5 Monitoring and evaluation. Once a budget is created, it's critical to monitor performance regularly to ensure that it is being adhered to. This involves comparing actual financial performance against the budgeted figures and identifying any variances. Regular reviews allow businesses to make timely adjustments and correct any issues that arise. 5. The budgeting process. The process of creating a budget typically follows these steps. 5.1 Define financial goals. Start by defining what the business aims to achieve financially in the upcoming year. These goals could include increasing revenue, cutting costs, improving profitability, or expanding operations. Clear goals provide a framework for allocating resources. 5.2 Gather historical data review past financial performance to understand revenue patterns, costs, and profits. Historical data helps in making informed assumptions and projections for the upcoming period. 5.3 Estimate revenues. Based on historical trends, industry standards, and market conditions, estimate the expected revenue for the upcoming year. This should take into account factors such as seasonal fluctuations, market competition, and economic conditions. 5.4 Identify costs and expenses. List all anticipated expenses. Separate fixed costs, e.g., rent, salaries, from variable costs, e.g., raw materials, commissions. This distinction helps in identifying areas where costs can be controlled or reduced. 5.5 Allocate resources. Once you have a clear idea of income and expenses, allocate resources to different departments and business functions based on priorities. Ensure that essential areas like operations, sales, and marketing have adequate funding. 5.6 Monitor and adjust. Once the budget is implemented, it's crucial to track actual performance against the projected budget, monitor variances, and adjust the budget as needed to ensure that the business remains on track. Summary. In this module, you've learned the fundamental aspects of business budgeting. Understanding the purpose and process of budgeting is essential for any business owner or financial manager. Budgeting not only helps in managing finances, but also plays a crucial role in strategic decision-making, performance measurement, and risk management. The next steps will delve deeper into the budgeting methods and tools you can apply to create effective and realistic business budgets.